Bitcoin people love to say it's the hardest money ever created, that it's inevitable, that if you don't believe, you just don't understand. But belief is not an investment thesis. Math is. If Bitcoin still worked the way people claim, nobody would need podcasts, charts, influencers, or narratives to explain it. The numbers would speak for themselves. They don't. So let's start with the one metric Bitcoin promoters avoid at all costs: compound annual growth rate. Compound annual growth rate answers a simple question. If an investment grew at a smooth, steady pace every year, what was that actual yearly growth rate from start to finish? This matters because time is not free. 10 years is not free. 20 years is not free. If you don't adjust for time, you are lying to yourself. When Bitcoin was tiny, its compound annual growth rate was absurd, over 100% per year. That's what happens when something goes from nothing to something. That phase is gone forever. Now measure Bitcoin honestly, peak to peak, cycle high to cycle high. Each cycle, the compound annual growth rate collapses, first triple digits, then around 35%. And now, based on diminishing returns and capital saturation, projections drop it into single digits, single-digit compound annual growth rate. That alone should end the discussion, but it gets worse. Compound annual growth rate means nothing unless you adjust for inflation. If your asset grows at 8% per year, but purchasing power is falling at 6 to 10% per year, your real compound annual growth rate is zero or negative. That means you took massive risk just to stand still. Bitcoin people will say inflation is fake. Fine. Then explain why everything costs more. You can't opt out of purchasing power loss by yelling at charts. Now apply Austrian economics, because this is where Bitcoin truly collapses. Under Austrian economics, real wealth comes from productive capital, cash flow, or assets with independent demand. Bitcoin has none of these. Bitcoin produces no yield. It produces no goods. It produces no services. It compounds nothing. It only goes up if someone else pays more later. That is not capital. That is speculation. Now add opportunity cost, which Austrian economics treats as sacred. Every dollar locked into Bitcoin is a dollar not working elsewhere. While Bitcoin sits idle, other assets compound, produce, or reprice based on real demand. Take silver. Silver has monetary demand and industrial demand. It is consumed. It is required. It does not rely on belief to function. Its downside is constrained by physical reality, not sentiment. Even if silver's price growth is modest, its opportunity cost profile is superior because its downside is limited, and its upside comes from monetary repricing, not narrative expansion. Bitcoin is the opposite. Its upside is capped by capital saturation, and its downside is unconstrained because it produces nothing. Now let's talk about the part nobody wants to admit because it's painful in real life. Friction. Bitcoin is sold as low-friction money. That is a lie you only believe if you've never actually used it seriously. You don't just buy Bitcoin, you open accounts, you submit identity documents, you scan driver's licenses, you wait for approval, you deal with compliance rules that can change overnight, then you pay exchange fees, you eat the market spread, you pay withdrawal fees, you move funds into wallets, you update wallets, you manage private keys, you remember passwords, you convert wallet formats, you pay conversion fees, you deal with failed transactions and delays. Every step bleeds money. Every step bleeds time. Every step adds risk. That is not low friction. That is a bureaucratic obstacle course built on fragile software. Now compare that to physical metals. You walk into a gold dealer with cash. You buy gold. You walk out. When you want to sell, you walk back to the same guy. You sell for cash. You're done. If you're even slightly competent, your total spread might be $40 or $50 per ounce. One time. That spread does not compound. It does not repeat. It does not bleed you every time you touch the asset. If gold's compound annual growth rate is even modest, inflation-driven appreciation alone covers that spread in months. In a bull run, it covers it in days. Bitcoin's friction never ends. Every interaction retaxes you. Every move reintroduces fees, spreads, delays, and compliance risk. Under Austrian economics, friction is a tax on capital. It raises time preference. It slows compounding. It destroys efficiency. High-friction systems are inferior systems, period. Now stack everything honestly. Bitcoin has collapsing compound annual growth rate. Bitcoin fails after inflation adjustment. Bitcoin produces no yield. Bitcoin has extreme volatility. Bitcoin carries massive opportunity cost. And Bitcoin is high friction in the real world. That is not hard money. That is not efficient capital. That is not superior. Bitcoin is not going to zero, but as an investment, it is already dead. Not because it will crash, but because time, inflation, opportunity cost, and friction already won. Bitcoin made people rich in the past. That does not make it a future investment. Real investing is not about stories. It is about time-adjusted growth, inflation-adjusted reality, opportunity cost, and friction. When you apply those honestly, Bitcoin fails.